All right, everybody. Thank you for tuning in. I am joined today by Carter McFarland, who is a fellow Kidder broker down in our Kidder Portland office. Carter is an awesome broker. He's a good friend of mine, and I always love getting his perspective because Portland is a very similar market to Seattle, kind of one of our sister markets, as we often call it. And Carter actually spends a lot of time on the office side of things versus me doing a lot of industrial transactions. And there's a lot of overlap in that sense. And in my opinion, office is arguably one of the more interesting product types to watch right now. Carter, thank you for joining me. I thought maybe we start here. I'm really curious, especially because we're coming here at the year end. If you want to give a just really brief overview of kind of what happened in your market in 23, and then maybe lead that into what you think is going to come in 24.
Yeah, definitely. Thanks, Matt. I would say 2023 year in review, we saw a lot of tenants going flight to quality, doing massive downsizes, and then going to higher class office buildings and trying to attract their employees back, and then also a preference for safety security. We're seeing rates continue to climb in the suburbs as people have wanted to move outside of downtown Portland. And then at the same time, just with the lender situations, a lot of office buildings being taken back by lenders, we've seen downtown vacancy continue to grow and rates continue to drop. Our vacancy is sitting right about 30% in downtown Portland, and then most of the suburban markets are kind of in the mid-teens right now.
Interesting. Okay. So you touched on a couple things there that I was looking at, like Seattle's market specifically. I think the Northwest gets a bad rap, kind of the whole West Coast, you could argue, right? Of are downtowns safe? What's going on with those, right? And I would argue Seattle has made dramatic improvements in that regard compared to, call it our low. And I've heard the same thing about Portland. But to your point, I think it's taught a lot of tenants. It's changed tenant behavior, right? And that's not unique to office. Probably one of the number one questions I get from my industrial tenants is, hey, Matt, I'm looking at this new building and it's, maybe 30 miles from their current building. Is this area safe? How do I secure this building? Do I have the ability to install a security system? So kind of going off of that, what kind of tenant behaviors are you seeing changing with groups, your tenant clients that you're working with? What are they, like, beyond, security aside, what else are they looking for?
Parking and proximity to amenities. Again, trying to attract these employees back from the work from home or the hybrid model. They're really trying to bring their employees back to the office, increase the innovation, and really kind of push their businesses forward. So I'd say parking outside of the security, I'd say proximity to amenities, and then also looking at what office buildings provide the most amount of amenities. And then the other thing, real estate and the real estate costs are such a low dollar item in a company's overall budget, of even trying to squeeze down that budget and go to some more budget options as well.
Interesting. Okay, so there's an office building here in downtown Tacoma where I'm at. And for those that don't know, Tacoma is about 35 miles south of Seattle. We're kind of the little brother of Seattle. And downtown Tacoma, we don't have a whole lot of Class A buildings. And there has been a flight to quality here too. The Class A buildings are actually doing really well. And so the landlords of some of these larger Class B buildings, they have been spending significant, arguably dramatic dollars amenitizing their buildings, just like you're talking about. We're talking, brand new cafes and bars in the lobbies, pool tables, bike storage. I always think of, a couple of years ago when WeWork and the group started putting, kegerators and stuff in their office. That was like, oh my God, I can drink beer at the office. This is amazing, right? But it's interesting. I've seen it work and I've seen it flop dramatically. And that there's one building down here specifically that I can quote that went from being 50% full to 99% full and at top of the market rental rates. And the feedback from the tenants that signed those leases is they love the remodel, they love the amenities that they put in the building, and it worked, right? And then I'm seeing another building right down the street that basically is copycatting the same thing, and they're not having the same effect. So why do I can't figure that out. I mean, what would you maybe chalk that up to?
Yeah, I think that's a really great question. So I'd say number one is just who's the landlord. We've been seeing a trend more going from institutional capital, tenants being more attracted to that, to going to more private capital groups. A lot of Portland, like probably over 50% of our buildings are owned by private capital. And so we've been able to see them being able to transact, being able to pay for TIs and kind of meet the market. Because they're not trying to just do a quick flip on a building. They're not trying to, redo the lobby, build a bunch of tenant amenities, build the deck, and then flip the building in 3 to 5 years. These are all long-term holds, and so they're able to meet the market. A lot of our Class A buildings that used to be high 30s, low 40s service are now, high 20s, low 30s. And that's the same price as a lot of these Class B office buildings that have been historic buildings that have also undergone significant remodels. And so we're seeing a lot of tenants being able to level up from, hey, I've historically been in Class B building. Wow, now for the same price or a little bit, sometimes even less, I can get into this really amazing Class A project. But I would say it just comes down to who the landlord is, and then what that reputation in the market is that's what we've been seeing is who am I signing this lease with? Are they a stout organization? Can they pay for my build out? Are they going to take care of me long term? Those are kind of a lot of the things that's driving a lot of those conversations.
Yep, and I've been seeing the same thing. Let's dive in on that. And I'm going to nerd out here on the numbers a little bit. So this is a big question I've been asking myself, and I ask around the groups, and I don't know if I've gotten a solid answer to it. Other than the answer, I'll give everybody the answer before I ask the question, which the answer that I've been getting is, what's my alternative, right? But so you were talking Class A buildings used to be 30, 40 for full service. Now they're 20, right? You have these tenants that are downsizing arguably in most of their space, and they're going in there and they have, and part of where the market's at, right? Tenants have more leverage. So they want a full turnkey build out. And I wouldn't be surprised if in a lot of these buildings, turnkey build out is $100 a foot, right? And so you've got a $20 full service rent with a $100 TI for those, just to do the math for those. That means that landlord isn't breaking even.
Mid 20s gross.
Yeah, so mid 20s gross, whatever it is, right? Landlord's not breaking even on that deal based on the TI build out until year 4, year 5. So if you're only signing a 5-year lease, you're basically breaking even at the end of the lease. I mean, if you sign a 10-year lease, it makes a lot more sense. You talked about a lot of the private capital, this is long-term holds. So I'm sure in their minds, that's how they can justify it a little bit more. But that's been a huge head scratcher for me is how in your mind can you underwrite a deal with that kind of cost that you don't break even in year 4 or 5? And the answer I've gotten is, what's my option, Matt? What's my alternative, right? And I don't disagree with the answer. I don't know. What do you think?
I think that you're buying the renewal at the end of the day. When you move a tenant into an office building, the landlord has a 70 to 80% chance renewing that tenant in place, especially like as an example, a lot of our activity recently has not been your tech firms. It's all been engineering, financial services, and law firms. Those are kind of the 3 big tenant groups that we have going around. And I think you were very generous about those payback periods, but a lot of these 10-year leases, we're not seeing these deals pay back for like 7 years on a 10-year term. We're seeing well over a year or 2 of free rent. We're seeing $100 to $200 TIs on 10-year deals, in some 12-year deals and some 15-year deals. It just kind of depends on the deal structure. But I think a lot of the landlords are sitting there scratching their head going, okay, well, is the deal I'm doing today better than the deal I'm going to do tomorrow? And I think, again, hitting back on 2023, I think it's going to get worse in 24 for landlords. I think that a lot of these landlords, like we've seen New York Life here in Portland, be very phenomenally aggressive in going and capturing tenants, bringing them to their buildings. And, now all people said at the time in 2020 and 2021, when they were doing a lot of these very aggressive deals, they were like, wow, that's crazy. Now a lot of those people are now having to do worse deals than that.
Yeah, it's interesting because it's so easy these days, especially given the macro economy, what we're seeing on boots on the ground in the market, to kind of have a little bit of a negative outlook, especially because we were coming off that high of all highs of peak market conditions back in 21, kind of beginning of 22. I'll tell you, I'm pretty bullish on 24. Not necessarily that 24 is going to be some, soar back to the moon statistical year and that we're going to hit all these, record highs. And those days are behind us because cheap money is, free money is basically gone, right? And it doesn't seem like it's coming back anytime soon. But what I'm seeing here, and this is a little more specific to the industrial side of things, but one, our vacancy has ticked up and landlords are realizing that I need stability in my buildings, which is completely contrary to what was happening previously. They would say, hey, we're going to hold out. We want our rate. We want our terms. And we think we have a line of tenants. So we'll pass on every deal until we get the one we like. Totally opposite now. And so, but what's happening is landlords are really focused on trying to keep their face rates high because they mark to market all their buildings. And so they can't just go backwards in rent. So what are they doing? They're giving tenants concessions via free rent, TI dollars, all that jazz. And this is nothing really new. This is going on across the country. But I bring all this up because if you look at all the stakeholders in the market, landlords, tenants, investors, maybe we focus on those three. All of them, I think, are actually shaping up to potentially have a very good 24 because I think tenants are going to get more than they've ever gotten in the past. Landlords are still going to achieve what they really need to achieve, which is stability in their buildings. And they're going to do so. I think they're going to be able to hold their rates, which at the end of the day, especially if they've held those buildings for a longer period of time, they're going to do pretty well because we're still, say what you want. We were on the hockey stick for a while, right? And so we're still hanging out up here. We haven't fallen off the cliff. So if you're signing in new rates, on call it 5-year lease terms, you're still going to hit new highs, which is fantastic for landlords. And then I think investors, particularly, while going out and getting financing is just not easy like it used to be anymore. We're seeing the buildings that are going to trade at discounts compared to where they were before, right? So people are going to get in at good basis. And if they get in at a good basis, they're already going to lease at a good basis too, if everybody does their math correctly. So, I for one am not taking a back seat on 24 thinking this is going to be our year of reset or our year to just kind of sit on the sidelines and watch. I think everybody who's active, it's going to be a good year.
Yeah, I think in any market, I think you can make money in a down market and you can make money in the best market conditions. I wanted to kind of ask you just a question about kind of Seattle, Tacoma, and just your guys' industrial market up there. What's your relative vacancy right now?
We're probably plus or minus 5 to 6%, probably getting closer to 6%. And at our kind of peak lows, we were probably 3% flat. So, our vacancy is basically doubled. Here's what you guys
seeing because of that low vacancy. Are you seeing more new construction come online, or rates climbing at all? How do you kind of foresee 2024 in future development?
Great question. And I have a thesis on this. And the best part about being a broker is I think I'm allowed to be wrong when I'm predicting the future sometimes, right? Anybody in real estate, I think, is we're all future crystal ball predictors, but we're wrong. We're wrong all the time, right? But here's Seattle specifically. Here's what I think is going to happen. We've been delivering a healthy amount of new construction industrial product year over year. And we're a super land constrained market. So you go to Dallas, you go to Phoenix, you go to Vegas, these big Reno, Nevada, these big, sprawling land markets. They have anywhere from 20 to 40 to 70 million square feet of new product coming out of the ground on an annual basis right now. It's not getting absorbed. It's too much product, right? Not to say that that's going to kill the market or won't get figured out here eventually, right? But Seattle, we've been probably averaging in the good years 5 to 10 plus million square feet a year, and it's been getting absorbed on an annual basis, right? Well, backtrack to the first interest rate hike back in March of 22, which is crazy to think that that's almost 2 years ago now. The land has been getting entitled. So we still have some new developments that are coming out of the ground, new developments that got delivered in 23, ones that are under construction that'll get delivered in 24. 25 is a huge question mark right now as far as what's going to actually come out of the ground. So what we're seeing right now is vacancy has ticked up. It's doubled. It's gone from 3 to 6%. And new construction, and that part of that is being driven by new deliveries, right? That always helps vacancy tick up. And assuming that product gets absorbed, whether that's slowly or quickly, right? How, pick your date of when that all gets absorbed. Guess what? There's no new product to backfill it. And we'll have a lag for probably a couple of years. And so I think what's going to happen is vacancy will keep ticking up, product will get delivered, then there'll be no new product. That product will get absorbed, vacancy will tick back down, rates will go back up. And theoretically, if we're all predicting, from an economic standpoint, we think that pick your date, 12, 24, 36 months, that I think we're all optimistic that things will be quote unquote humming again in some fashion. So if you fast forward to 25 or even 26, and go, holy cow, we just absorbed all that new product. We don't have any new product to backfill it. Tenants need a ton of space because the economy is humming again. We're going to have a problem. And it's a problem in the, at least for us on the brokerage side of things, not a huge problem. We're going to have trouble finding space for our tenants, right? But overall, everybody's property values are going to increase, rent's going to increase. It's going to be, that's kind of my thought. It's going to be interesting.
Yeah, and it just seems like I totally agree with you on 24. I think that historically, when you look at election years, the economy's normally pretty stable or it gets a little bit better. There's, people don't want to make any massive moves. And so I have a lot of hope for 24 and 25 that things will get better. I think, it's just funny, a tale of two different stories in two different markets and just two different business lines. On the office side, for next year, I think it's again going to be a more tenant favorable market. I think we're going to see more buildings go back to the banks. Unfortunately, we're going to see vacancy continue to rise in downtown. But out in the suburbs, I think there's a lot of very positive things going on. Rates are at all-time highs. Vacancy is still kind of in the mid-teens, mid to higher teens. But with Intel announcing a lot of new work that they're going to be doing out at their campus, I'm really hopeful that that will spur some further tenant activity of people needing to serve Intel and all those subcontractors and different people that work for them and different suppliers, that will also spur some additional tenant activity. Mm-hmm. We're really not seeing any new construction in office, obviously. But what I'm hopeful for is what you'll see is when some of these buildings go back, like, MetLife, New York Life, some of these larger groups have taken buildings back, is that now they're able to offer these buildings that candidly, in my personal opinion, were unaffordable for your average tenant in Portland, where they're, low 40s gross. Candidly, a lot of companies can't afford that. And so it's going to kind of reset our market. So I'm very excited about some of these offerings of, hey, low 30s Class A building that used to be, low 40s, and some of those clients being able to get into nicer product for better rates.
I think the word you use, reset, is that's been a common theme. Everyone's backtrack back to 2008. That was the Great Recession. Everybody says right now we're going through the Great Reset. And I tend to agree, right? It feels much more like a reset than a recession. It's just everything getting recalibrated, everybody resetting their expectation. Tenant behaviors have changed. Everybody's behavior has changed, right? Coming out of the pandemic and all that.
I mean, you kind of look at the office market in Portland in 2015, we really just kind of started skyrocketing. I remember seeing my first like 32 to 34 full service number being like, oh my gosh, that's so expensive. And, kind of the height of it, 19, I mean, there was space that was, $50 a foot. And so I think that our market skyrocketed very quickly. And I think that it's going to kind of set back more to reality. And I'm really excited, just, I'm more of a tenant rep broker myself, of just being able in these down markets to go run a strategic process with a client, being able to go out and get them a lot of concessions and get them to be very happy. I think that this is, candidly a once in a lifetime opportunity. I think that there's going to be a lot of people in 4 to 5 years that are kicking themselves going, hey, why didn't I buy that office building for $75 a foot? Hey, why didn't I go take this opportunity? Hey, instead of signing a 5-year lease, why didn't I sign a 10 and get, an extra year of free rent? I think that there's going to be a lot of people looking back on this. Hindsight's obviously 2020, but I think there's going to be a lot of people kicking themselves for not being more aggressive in this market.
I think you're spot on. Completely agree. Okay, so last question I'll hit you with, and this is kind of separate from product type and what we're doing. What are you doing 24 from the brokerage side of things to better yourself, better your business? Are you doing anything different? What's kind of your focus and goal for 24?
Yeah, I think the number one thing we always, you referenced it earlier with just the crystal ball of, hey, what's the economy going to do? What's going to happen is just really diving in and reading more about the industries that I support. I do a lot of work with data center, semiconductor stuff. So really trying to learn those industries, and then B, just really understanding macro and microeconomics a lot better. So just primarily doing a lot of reading a lot of books, watching a lot of videos, listening to podcasts, different stuff like that, and just trying to be really schooled. I think brokerage has really changed over time, where now we're almost in some instances a business advisor. And so I think that people look to us as, for a multitude of different reasons of helping build their business. Hey, how can I be more successful if I move to this building versus this other one? How is that going to help my business? I think we've had to become more well-rounded. So that's kind of the main thing that I'm doing.
Yeah, I agree with you there. I think we're brokerage. This is nothing new, but brokerage has pivoted to, as much as we're service providers, we're what are we dealing? As much as we're dealing buildings and services, we're dealing information, right?
Yeah.
And so those that stay on top of their information, I think, are going to benefit their clients. The other thing that I'm doing similarly is, when the market was humming, we were all moving so fast and everybody had to make decisions so quickly in order to get things done, right? If you wanted to win a deal or really transact in any fashion, you had to move fast, right? And I think people were looking over things, right? And it's okay when you look back on it in hindsight, right? Because it was necessary. You had to. But now that everybody has a little more time, I think, theoretically, to be more deliberate in their decision making, I'm trying to, on the brokerage side, be much more deliberate in my process, in the service I'm providing these clients, and really taking, like, for example, I've built this, call it 75-point checklist on every deal that I do, and I go through it for every single deal that I do to make sure that nothing is missed, because when you're going so fast, it's easy to skip over some of the details. And I believe that clients will appreciate when they understand that that's being done for them on the back end, because they want our knowledge, they want our expertise, and they want our service. But a lot of us, we're pretty parallel in what we offer, right?
Yeah.
So the more we can differentiate ourselves and provide an above and beyond level of service, I think that's, in these tougher markets, that's what resonates. That's just my 2 cents.
And on just one quick thing on that time piece, I think that that's something I'm working on as well. I think that these deals are just taking so much longer to put together, especially on the office side with, we've talked about it a couple of times, but the construction costs, but, primarily municipalities are taking longer times to approve permits. The process in general just seems so much longer and protracted. Our average office deal used to be like about 6 to 9 months. I'm starting, any deal of size about 18 months out now. And so, I'm working on deals that are up in 26 today.
Yeah.
So, really being out ahead of things and really trying to drive that value for the client.
Yep, I'm with you. Well, Carter, thank you for joining me. I always appreciate your thoughts and insights. You're crushing it down there in Portland. Anybody who needs help with space down in Portland, give Carter a call. I guarantee you he can help you out. So, but let's plan to do this again in the new year.
Yeah, definitely.
I'd love to chat with you
again.
Love to.
Thanks for the time. I really appreciate it.
Yep, you got it. Take care.
Bye.